The specter of recession has haunted economic forecasts for months, casting a long shadow over global markets and personal finances. Inflation, rising interest rates, and geopolitical instability have fueled anxieties about a potential economic downturn. But amid the widespread concern, a dissenting voice has emerged, offering a counter-narrative that challenges the prevailing pessimism. This perspective hinges on the fundamental strength of the American consumer and the resilience of the labor market, suggesting that the overall U.S. economy may be more robust than many believe. Is this optimism justified, or is it a premature dismissal of real economic threats? The answer could determine the financial future of millions. The economic climate of the past few years has been turbulent, marked by unprecedented challenges and uncertainties. The COVID-19 pandemic triggered a sharp economic contraction, followed by a period of rapid recovery fueled by massive government stimulus and pent-up consumer demand. This surge in demand, however, outstripped supply chains, leading to soaring inflation rates not seen in decades. To combat inflation, central banks around the world, including the Federal Reserve in the United States, began aggressively raising interest rates. These rate hikes, while intended to cool down the economy, also raised fears of a potential recession. Historically, aggressive monetary tightening has often been a precursor to economic downturns. The combination of high inflation, rising interest rates, and lingering supply chain disruptions has created a complex and precarious economic landscape, making it difficult to predict the future with certainty. In this environment of uncertainty, any assessment of the recession risk must be carefully considered. Richard Bessent, Chief Investment Officer at Key Square Capital Management, has presented a viewpoint that diverges from the widespread recessionary fears. His assessment, articulated in a recent interview, posits that the U.S. economy as a whole is not at risk of recession. This optimistic stance is primarily based on two key pillars: the strength of the American consumer and the robustness of the labor market. The consumer, who accounts for a significant portion of economic activity, continues to demonstrate resilience, maintaining spending levels despite inflationary pressures. This spending is supported by healthy household balance sheets and a willingness to dip into savings accumulated during the pandemic. Simultaneously, the labor market remains tight, with unemployment rates hovering near historic lows. This strong labor market provides income and job security, further bolstering consumer confidence and spending. Bessent's argument suggests that these fundamental strengths are sufficient to offset the negative impacts of inflation and rising interest rates, preventing a broader economic contraction. His perspective offers a counterweight to the prevailing pessimism, highlighting the underlying resilience of the U.S. economy. The central issue lies in the stark contrast between Bessent's optimistic outlook and the widespread concerns about a potential recession. While he emphasizes the strength of the consumer and the labor market, many economists and analysts point to warning signs such as declining consumer confidence, slowing economic growth, and an inverted yield curve, a historical indicator of recession. The paradox is that both sides can point to valid data to support their respective positions. Consumer spending has indeed remained relatively strong, but it is also showing signs of slowing down as inflation erodes purchasing power. The labor market is tight, but some sectors are already experiencing layoffs, and wage growth may not be keeping pace with inflation. The controversy stems from differing interpretations of the same economic data and varying degrees of emphasis placed on different indicators. Bessent's perspective represents a bullish counterpoint, challenging the dominant narrative of impending economic doom. However, the validity of his assessment hinges on the continued resilience of the consumer and the labor market, which are both subject to unpredictable forces. The question remains, are these strengths sufficient to withstand the mounting economic pressures, or will they eventually succumb to the forces pushing the economy towards recession? The assessment of recession risk carries profound implications for individuals, businesses, and the overall economy. If Bessent's optimistic view proves accurate, it could mean continued economic growth, job creation, and investment opportunities. Consumers could maintain their spending habits, businesses could continue to expand, and investors could remain confident in the market. Conversely, if the recessionary fears are realized, the consequences could be severe. A recession could lead to job losses, reduced consumer spending, business closures, and a decline in asset values. Individuals could face financial hardship, businesses could struggle to survive, and the overall economy could suffer a significant setback. The accuracy of the recession risk assessment therefore has a direct impact on financial planning, investment decisions, and government policies. If policymakers underestimate the risk of recession, they may fail to take appropriate measures to mitigate its impact. Conversely, if they overestimate the risk, they may implement policies that stifle economic growth. The stakes are high, and the outcome will shape the economic landscape for years to come. The potential impact of avoiding a recession, as Bessent suggests is possible, is significant. Continued economic growth would likely lead to further job creation, benefiting workers across various sectors. Businesses would have greater confidence to invest and expand, driving innovation and productivity. Consumer spending would remain robust, supporting economic activity and preventing a sharp downturn. The stock market would likely continue to perform well, benefiting investors and retirees. On the other hand, if a recession does occur despite Bessent's optimism, the consequences could be far-reaching. Job losses would increase, leading to higher unemployment rates and financial hardship for many families. Consumer spending would decline, further dampening economic activity. Businesses would face reduced revenues and profits, potentially leading to closures and bankruptcies. The stock market would likely decline, eroding wealth and impacting retirement savings. Government revenues would also decrease, potentially leading to budget cuts and reduced public services. The impact of a recession would be felt across all segments of society, highlighting the importance of accurately assessing the risks and taking appropriate measures to mitigate the potential damage. The future trajectory of the U.S. economy remains uncertain, and several key factors will determine whether Bessent's optimistic outlook proves to be accurate. The continued strength of the consumer will be crucial. Will consumers continue to spend despite inflationary pressures and rising interest rates? Will they be able to maintain their spending habits as savings dwindle and credit card debt increases? The labor market will also be a key indicator. Will the unemployment rate remain low, or will we see a significant increase in job losses? Will wage growth keep pace with inflation, or will workers experience a decline in real wages? The Federal Reserve's monetary policy will also play a critical role. Will the Fed be able to successfully combat inflation without triggering a recession? Will they be able to fine-tune their policies to achieve a soft landing for the economy? These are just some of the questions that remain unanswered, and the answers will ultimately determine the fate of the U.S. economy. Investors, businesses, and policymakers should closely monitor these key indicators and be prepared to adapt to changing economic conditions. The debate over the risk of recession in the U.S. economy highlights the inherent uncertainty of economic forecasting. While some indicators point to potential weakness, others suggest underlying resilience. Richard Bessent's optimistic assessment, based on the strength of the consumer and the labor market, offers a counter-narrative to the prevailing pessimism. Whether his view proves accurate remains to be seen, but it underscores the importance of considering multiple perspectives and avoiding premature conclusions. The future of the economy hinges on a complex interplay of factors, and only time will tell whether the U.S. can successfully navigate the current challenges and maintain a path of sustainable growth. The coming months will be critical in determining the ultimate outcome.